Right, good morning to our wonderful audience, and welcome back to Boutiques on Wednesdays again. Looking at the US forward yield curve, the market suggests a sharp rate cut that might very well be great for equities. However, if you look at the Fed dot plot of all the Fed governors, it suggests that rates may stay longer or higher for longer, which could result in further contraction in earnings. Who is right, the Fed or the market? Will we ever know? Are we at a point where in the cycle where it favors more cyclical value-orientated stocks? And just here to share their expert views and with their introductory presentation to our audience is T. Rowe Price. T. Rowe Price is truly one of the top global investment firms with assets under management in excess of 1.3 trillion US dollars. Joining us now all the way from London is Andrew Clifton, portfolio specialist at T. Rowe Price for the Global Value Equity franchise. Good morning, Andrew. It's really a great privilege to have you join our session today. And from our side, from the BCI side, we're very excited to announce the launch of the BCI T. Rowe Price Global Value Equity Feeder Fund. Your fund's been in existence for a very long time. T. Rowe Price has been running for decades. So some of our audience might be familiar with you. But like I said, exciting times that ZAR investors can now get access to a truly great fund. So thank you again for your time this morning. It's really a great privilege to have you with us.
Thank you, Eugene, for the very kind introduction. And I'm delighted to be able to talk to you and your audience about the T. Rowe Price Global Value Equity Fund. You very kindly gave a quick introduction to T. Rowe Price, but perhaps if I can just start with a few words on the firm before focusing much more specifically on the fund. Can you see my my screen?
Okay. I can see your screen, but it's your Windows screen.
Okay, sorry, let me just try again.
No problem.
Can you see a page about T. Rowe Price?
Yes, there we go. It's perfect.
Okay, well, just to confirm, just a few comments about T. Rowe Price. So we are a global active asset manager, very much focused on rigorous proprietary fundamental research. Of our total assets of over $1.3 trillion, over half is in equities, and as we'll see in a moment, a very significant proportion are in our value equity franchise. We're also, as Eugene said, a very stable, long tenured organization, and value investing is a critical component of our offering. If I just turn on to the global value resources specifically, on this page, you can see across the top, myself and my colleagues on the Global Value Equity team, myself and the portfolio manager, Sebastian Mallet, and a dedicated analyst. But we are very much positioned within a strong value franchise within T. Rowe Price. A number of other value managers based in the US, running US value, both large cap and mid cap, but also international value managed out of London, and also emerging markets value managed out of Hong Kong. And this is a very collaborative team where we share ideas. And essentially in the Global Value Equity Fund, we are trying to find the best 80 to 100 value ideas from around the world. So working with these colleagues is a great way of narrowing down the opportunity set to find the best opportunities. As I mentioned, value equities is critical to T. Rowe Price. And on this page, you can see the way that the assets have grown over many years. Essentially, from the 1980s, we have been launching value equity products. And across the bottom of this page, you can see the timeline of product launches. Global Value Equity launched in 2012, very much a logical continuation of our measured rollout. And the AUM at over $180 billion in value franchise, value equity franchise, is clearly extremely appreciable. The second key component, though, alongside our strong heritage in value equities, is really the fundamental research platform that we have. And we work very closely with these analysts. It is a platform that works with all of our strategies So they are style agnostic. We look for them to be industry experts and to understand companies and industries better than the market and our competitors. And we have close to 200 equity research professionals located in 10 different investment offices around the world. And on this page, you can see the details of the team, a very busy slide, but hopefully it impresses upon you both the depth and also the geographic strength that we have looking across the different industries that we do invest in. So let me turn specifically to the Global Value Equity Fund itself and just give you an introduction to the philosophy and the process that we adopt. The market anomaly that we're looking to exploit is that basically many investors do not like uncertainty and controversy creates opportunity. The market perception of equities can change much more than the true intrinsic value of a company when there is a perceived problem, and that dislocation from intrinsic value can give us an opportunity. The first step for us is really to understand why the share price maybe has fallen in relation to a controversy or a problem, and critically to assess whether this problem can be resolved. Value investing is littered with value traps, and many companies can appear to be very cheap, but there can be fundamentally sound reasons why their valuation is very low. And we are extremely cautious about getting involved in situations where we cannot see a clear path towards resolution. If we do believe that the problem can be resolved, then essentially we work with the analysts to try and understand the degree of mispricing that has occurred. And in particular, we always start with the potential remaining downside that could exist in a situation. But critically, we then need to look also at the more optimistic outturn. What is the potential upside? And essentially, we are going to be interested in situations where the risk reward in terms of upside to downside is of a ratio of 3 to 1 or so. We also not only focus on the best asymmetric opportunities, but I think a critical component of our fund, and quite distinct from many of our competitors in the value equity space, is that we look to do this across the value spectrum. So we invest not just in either deep value names or controversial turnaround stories, but we also invest in higher quality, more defensive value names that are well supported by cash flow. And this broad representation across the value spectrum is persistent. The exact allocation will evolve according to opportunity, but we will always maintain that consistent exposure to different types of value, because different types of value are effective at different times. And I'll elaborate on this point a bit more in a few moments' time. So on this page, we can really see the anomaly that we're looking to exploit. We have an estimate of the intrinsic value of a company, but there can be a concern that weighs upon the sentiment towards the share price, dragging down the share price below its intrinsic value. It could be due to a general market concern, such as the economic outlook. Maybe the economic cycle is deteriorating, but also it can be very company specific. For example, a concern about a particular product, perhaps competitor actions, maybe an ESG concern. So what we need to do is to understand how likely is it that this problem can be resolved, and then we will be interested if it can be resolved and the opportunity does present to us a very asymmetric, attractive risk return profile. On this page, you can see the presentation of the value spectrum. So on the left-hand side, we have what we call our defensive value allocation. And these will, on average, be around 50% of our fund. We can find these higher quality companies with generally good levels of free cash flow generation, particularly in sectors like consumer staples, healthcare, and utilities. But these companies can still face perceived or real problems. For example, a healthcare company may have a particular issue around an existing blockbuster drug that may be coming under competitive pressure. Perhaps the market doubts the ability of the drug pipeline to develop to grow the business over the next 3 to 5 years and beyond. So we work with our pharmaceutical analysts to really have an edge against the market in terms of our understanding of the situation. A utility company may face a perceived regulatory issue. In the last 12 months, as the energy crisis has bitten deep within Europe, many regulators have taken a more aggressive stance, and we need to understand the reality of how permanent could these regulatory actions be. So around half of our portfolio will be in these more defensive value names, but we also shift over to the right and we trade quality for upside. We go into lower quality, more cyclical companies where there may be less financial strength. Perhaps management teams are not perceived so highly. There may be occasionally an ESG concern. And ultimately, as we take on these more cyclical exposures, we end up in the traditional deep value allocation. And these companies are lower quality. We need to be more careful about investing in this area. And we certainly manage individual position sizes quite carefully. We never want to lose more than 25 to 30 basis points of capital in an individual name. So if we could potentially still see 50% downside in a highly controversial name, it will be a fairly small 50 or 60 basis point position within our fund. But if it does work out, the reason we will be invested is because if it has 50% downside, we can also see a path to 200% or 300% upside. So it can still have a meaningful impact on performance despite a small individual position size. But also collectively, these cyclical and more deep value companies will be representing, on average, around half of the portfolio. So that is essentially how we construct the fund. You will always have a broad exposure to a range of different types of value within the fund, which means that in environments where value is out of favor, where there may be a risk-off environment, but our defensive, higher quality companies will be providing a good degree of performance protection. And in more risk-on markets, more value-oriented markets, it will be our cyclical and deep value companies that very much come through and drive performance. And historically, what we have seen is that in what for the last decade has been a very much anti-value environment, our performance is generally kept closely in line with the core benchmark, MSCI World, and ahead of our value peer group and the value benchmark. But within that, whenever value has performed well, we have offered a good degree of participation. So again, we are looking to deliver a less volatile pattern of performance, and a critical means of doing that is by having this continued broad exposure across the value spectrum. Let me turn on now and maybe just talk quickly about the process in a bit more detail before looking at positioning and performance. Essentially, we are presented with a very broad opportunity set of over 4,000 possible opportunities. We invest primarily in developed markets. We are benchmarked against MSCI World, but we can allocate up to 10% in emerging markets. And also, clearly, we have a good representation in large caps and mega caps, but we also have dedicated analyst resources in the small cap and mid cap space. And we also make good use of the opportunities there. And we'll look at the data behind that in a few minutes' time. But essentially, a very broad opportunity set. But when we look at the value opportunities that our analyst platform is especially recommending to us, and also by working with the other value managers within our firm, we can quite quickly shrink our potential opportunity set down to a more focused list of around 400 or so opportunities. This list is continually evolving depending upon market action and also the fundamental research of the platform. But essentially, it gives us an ability to really focus on what we feel is the strongest pool from which to select the 80 to 100 stocks that will be included within the value equity fund. What we do is we assess what is the problem, what is causing the dislocation in the share price, why is this company appearing to be lowly valued, below the intrinsic value that we believe it's worth. And then we really need to understand whether this problem can be resolved, what are the key signposts to look out for, And if the problem is resolved, then what is the potential upside versus also what is the remaining downside if we are wrong. And then the resulting portfolio will essentially be comprised of the most attractive asymmetric opportunities that we can find, but we will always make sure that we have a good degree of exposure across the value spectrum, making sure that we are not overly exposed to any one particular type of value, and also making sure we have a good degree of diversification across sectors, countries, and also market capitalization. Maybe if I now turn on to the issue of positioning, and we see where we are finding the best opportunities currently. Firstly, before looking there, just to clarify the parameters of the Global Value Equity Fund. As I've mentioned, our primary benchmark is MSCI World, but we also monitor performance against MSCI World Value, and performance against our value peer group is a critical component of how we assess how we are doing in managing the strategy. We do allow a degree of diversification against that benchmark. Country ranges are typically plus or minus 10%, and the US can be of a broader divergence than that. Emerging markets can be up to 10%, as I mentioned, and in order to capture the best value opportunities that we can find, we do need to allow a good degree of divergence at a sector level, and typically we are operating within, we have an indicative band of plus or minus 15% versus benchmark. Usually we are within a band of plus or minus 10%, but we still are offering a good degree of active exposure. We will typically look to be fully invested, essentially, perhaps sometimes leaving a bit of cash in hand to take advantage of opportunities that may emerge very quickly. And the number of holdings, as I've mentioned, is between 80 to 100. At a sector level, as you can see on this page, we have broad exposure across all of the sectors in the marketplace. Our most active overweight exposures are currently concentrated in healthcare, utilities, and financials. There are certain sectors that do have a bigger value footprint by the nature of the companies that make up their constitution. And the classic value sectors are energy, financials, and utilities. And indeed, you'll see that we are currently overweight all of those sectors. And that generally has been the pattern through time, but not universally so in all cases. Energy in particular, a few years ago, we were underweight, but clearly the events in Eastern Europe over the last 12 to 15 months have structurally changed the outlook for the energy market, and we moved overweight that sector last year. But utilities and financials have been fairly persistent overweights in our fund. Healthcare is currently the largest overweight, and healthcare is not really a traditional value sector, but it was a sector that was out of favor in the marketplace. If we go back a couple of years, it was perceived as being dull, as representing little opportunity at a time in 2021 when the market was looking for more exposure to the economic reopening after the pandemic. Also, many healthcare companies faced idiosyncratic challenges, and there were concerns about US drug pricing. So that gave us opportunity. And indeed, through 2021 and into 2022, we did add to that sector. More recently, in the last 12 months or so, it has become more of a consensus sector, particularly as the market has been concerned about the economic outlook. And that has meant that some opportunities have become less pronounced. So although it's our largest overweight, we have been trimming the sector to an extent, and I would expect that to continue for the next 3 to 6 months as well. In terms of the largest underweights at a sector level, there are, just as there were with traditional value sectors, there are some sectors that do have a bigger growth footprint. And in particular, information technology and also consumer discretionary. So perhaps it is no surprise to see that they are our biggest underweights. But even within those sectors, we can find opportunities. And within information technology in particular, within the last 3 to 6 months, we have been adding to cyclical technology and specifically the area of semiconductors and semiconductor equipment. This is an area that offers growth opportunities in the longer term, but it's also very cyclical. And the market has been concerned about the extreme downturn that we are seeing in semiconductors in the current year. And that undoubtedly is true. But also it is an industry that has consolidated dramatically over the last 5 years. It is an industry whose products are becoming all pervasive. And interestingly, they will be a key component of the drive towards the explosive growth in artificial intelligence over the years to come. And many of these semiconductor companies, though, had been pushed onto lower valuations because of these shorter term trading uncertainties. This gave us the opportunity. And indeed, as I said, we have been adding in the last 3 to 6 months. And although this year will be very tough, in 2024 and 2025, we do expect to see a very strong recovery in that industry. On this page, you can see the time series of our sector representations. And at the bottom, you can see the historic pattern of our allocation to IT. So again, to confirm, it is still an underweight position, but in cyclical tech, we have been finding opportunities. And although we are underweight, even in growth sectors, we can find good opportunities. From a geographic basis, on this page, you can see the snapshot as at the end of March. We do have this allocation to emerging markets, currently of the order of 7%, and that is represented by exposure in countries such as Brazil, India, Vietnam, and China. Again, these are ideas that have been identified by our platform, and especially by working closely with our emerging markets value strategy. Most of these ideas are being funded by our underweight allocation to the Americas, and in particular, the United States. And on this page, you can see that our allocation to that region has historically been an underweight one. It is the black line at the bottom. But with the Americas and the United States specifically representing close to 70% of the benchmark, we still have a very meaningful allocation to that market. And indeed, we can find many, many attractive value opportunities. It is just that relative to the benchmark, we do find better opportunities in some sectors in other parts of the world. But there are certain sectors such as utilities, financials, and pharmaceuticals, where US companies are really the mainstay of our representation. But in other sectors, such as industrials, for example, and other more cyclical parts of the marketplace, companies in Europe or Japan do represent a more appealing risk-reward opportunity to us. Also, just the further characteristic of our fund I would highlight is from a market capitalization perspective, where we do see clearly good opportunities in mega caps and large caps, but we do have a greater than benchmark representation in mid caps and small caps. And again, we do benefit from having significant analyst resource focused on those particular parts of the marketplace. And also, as a general point, not just within value equities, but across many of our equity strategies, we do find that as we go down the market capitalization spectrum, that there are greater inefficiencies that we can exploit. And this, as you can see on this page, is a fairly persistent pattern, a good allocation to mega caps and large caps, but to an underweight extent relative to the benchmark, and companies that are less than 10 billion, and in some cases less than 5 billion, are also an attractive source of opportunity for us. Let me just spend a minute further on the broad exposure of the fund across different types of value. And as I mentioned earlier, we do believe it's important to have this broad exposure to different types of value, defensive value companies, which are marked by good levels of free cash flow, but can be good compounders over the longer term. They are a very persistent and consistent allocation. And you can see here, they are the darker bars on this line. So really since inception of our fund in 2012, we have typically had between 40 and 60% of an allocation. But at the same time, we also have that persistent allocation to more cyclical and deep value companies, represented by the orange and green bars, respectively. The exact evolution, as I mentioned earlier, will evolve according to opportunity. And at certain times in the marketplace, when value is really out of favor, when perhaps there is a very high level of fear, maybe a concern about recession. Certainly, this was an environment that we saw when the pandemic struck in 2020. That can be a time to take on more risk and to embrace more deep value and more cyclical companies. And at such times, we do see valuation spreads widen, cheap companies become a lot cheaper as many investors rush into higher quality perceived safe havens. But this is the opportunity that we look for. And you'll see on this page that in 2020, we did go down to about a 35% allocation to defensive names. So by implication, we had about a 65% allocation to cyclical and deep value companies. But despite the extreme disruption in the marketplace, this was as far as we wanted to go in terms of tilting the portfolio. Because if the market had continued to worsen, if, for example, we'd had an economic depression, if the pandemic had developed in an even worse fashion, then our cyclical and deep value companies would not have performed well. But by taking the portfolio to that profile, we could exploit the opportunities that were being presented. And subsequently, as the market has recovered, as many of those more extreme value names have performed, then our allocation has come back towards a more balanced profile of broadly a 50-50 allocation. Let me just now show you a quick example of some of the key names in the portfolio. What I would emphasize is that when you look at the top 20 names in the portfolio, you will be getting a view maybe of the more defensive, higher quality companies in the portfolio, because as I mentioned earlier, our higher risk names, those that are more cyclical and deep value, are controlled at an individual level, although collectively they can represent a good exposure that do drive a lot of the performance of our fund. But in terms of our biggest overweights, actually our current biggest overweight allocation is currently to Microsoft, although this is an underweight allocation relative to its weight in the benchmark. We have held Microsoft since the fund's inception in 2012. It is a name that has performed extremely well, and we continue to trim our exposure to that name. But we are also very risk aware, and we are underweight many of the heavier growth names within the MSCI World Benchmark. And as we'll look at in a moment, that can have an impact upon performance. So the position in Microsoft is firstly giving us exposure, albeit an underweight one, to one of the world's greatest companies, but is also serving as a useful risk management tool. Beyond that, though, you can see a range of more defensive, higher quality companies, such as Southern Company, which is a US utility business, AstraZeneca, one of Europe's fastest growing pharmaceutical businesses, and also further down the list, Total, which is one of our key energy exposures. But if you look at the profile of the fund on this page, which shows all of the holdings within our fund ordered by market capitalization, this gives you a broader sense of the true diversity that we offer across the value spectrum, not just high quality, more defensive companies that will be the individually single largest positions, but also we do encompass a lot of more cyclical, deep value names within our 80 to 100 holdings, and also making very good use of small cap and mid cap names. Before concluding, let me just spend a few words just summarizing the characteristics of the strategy before we look at the performance. So here you can see characteristics of our fund against the MSCI World Benchmark. And we do display traditional value characteristics, and this has been persistent through time. So if you look at our price to book measure, We are trading at about half the valuation accorded to the core benchmark and broadly in line with the figure for the MSCI World Value Benchmark. On a price to earnings basis, we are trading at around 15 times, meaningfully below the 20 times or so of the market more generally. And also the investment weighted median market cap of the fund, you can see, is appreciably below the benchmark figure, again, illustrating the way we are exploiting our broad opportunity set. And the active share of the fund at consistently in excess of 80% shows that this is a truly actively managed strategy. And let me conclude before giving time for some questions in terms of performance. Over time, as we are benchmarked against MSCI World, it has clearly been a challenging benchmark to match, given the strong growth characteristics over much of the last decade and beyond. But you can see that since inception, and indeed over the longer term, we have broadly managed to stay relatively close to the MSCI World benchmark. But when you compare our performance against the MSCI World Value benchmark, then we are consistently performing ahead of that benchmark. Just by way of illustration, since inception, the MSCI World Value benchmark is up about 7.5%. So we are adding well over 100 basis points of excess return annualized against the World Value benchmark since inception. Over the more recent time period, as value has come back into favor, you'll see that over 1 and 3 years, we are performing ahead of the MSCI World benchmark. It has been a more challenging year to date because unlike 2022, which was a strongly pro-value market, in the current year to date, growth has had a temporary resurgence and we are quite appreciably behind the MSCI World benchmark, but we are performing ahead of the MSCI World Value benchmark. What I would highlight as well is that in terms of the performance attribution in the current year to date, it is very narrowly concentrated in terms of the underperformance in a handful of names that have been extremely strong in the market, but as a value investor, we cannot really justify exposure to. Names like Apple, Tesla, Nvidia. These have been the principal detractors from performance in the current year, as well as our underweight allocation to technology and consumer discretionary. And as we look now over the remaining months of this year, but more critically over the next 2 to 3 years, we do see continued extremely strong opportunities for value. And we continue to believe that our strategy will not only offer good performance against the MSCI World benchmark in a more value friendly environment, but also we look to continue to add good value against the good returns against the MSCI World Value benchmark and also our value peer group. So let me stop there, Eugene. I'm aware of the time and I'd be delighted to take any questions that you or the audience may have.
Andrew, thank you so much for that. A lot of field to cover in a short space of time, especially since this is an introduction to a lot of our audience. I think maybe just let's talk about, you ended off with, we are in a more value-friendly cycle. And I think that's probably one of the areas that a lot of us grapple with, do we allocate more to quality or to value? So maybe from your perspective, and I mean, I've mentioned it in my introduction as well, if you look at the Treasury yield curve, it suggests that we could possibly see a rate cut maybe before the end of the year. But if you look at the Fed dot plot, they persist that rates are going to stay higher for longer. So in your opinion, where are we in that cycle and why would you then say we are on a more value-friendly area?
Well, Eugene, I think at the very least, we're at least going to be presented with a more level playing field than has been the case for the last decade. Because although the rate cycle is likely to peak in the near term, and we may well see some rate cuts towards the end of this year or next year, I think it is very hard to believe in any argument that we're going back to a zero interest rate world which really marked much of the last decade. And we see that period really as an abnormal time period. And it clearly was extremely difficult for value investors, not least because of the valuation mechanics. When you have a zero discount rate, it's almost like saying that gravity is abolished if one is studying physics. If you have a zero discount rate, then there is no difference between a cash flow generated this year and one in 30 or 40 years. So obviously that steered investors, many investors, towards growth investing. And also it did very materially penalize traditional value parts of the marketplace, such as financials. And a general deflationary environment also penalized many real asset, commodity-driven companies as well, which again have a heavy value representation. I think from here, in the short term, then yes, perhaps inflation is heading in a downward direction. Yes, rates are close to peaking. But over the next 3 to 5 years, we do feel we are going to be faced with an environment where rates will maintain at a certainly positive level, but also there will be continued inflationary impulses. We are not going back to a world of deflation where central banks can be extremely accommodative. So inflation, because of the need to invest in many industries, because of social considerations, particularly were a recession to strike, and also because many industries have not invested enough, and because there is this pattern of reshoring, there is this pattern of decarbonisation, we feel that against a backdrop of really under-investment for the last decade, we're going to see this inflationary impulse continue to resurface. And again, we do not know exactly what inflation will pan out over the next 3 to 6 months at, but I think it is going to be a continuing theme that will challenge investors, and the value recovery that we have seen in the last couple of years is not just to be a short-lived bounce. It is one that we feel will have continued impulse because of this changed market dynamic.
Does this imply that you can potentially increase your exposure to more cyclical stocks?
Absolutely. And when we are presented with opportunities, as indeed we have been in the last 3 to 6 months in cyclical tech, as I mentioned, we have been slightly leaning into more cyclical areas of the marketplace. So although the allocation is broadly balanced between defensive value and the more aggressive types of value, the defensive value has slightly decreased in the last 3 to 6 months. But we are not really being paid to take a more dramatic stance. The valuation spread within the marketplace is close to the longer term averages, still giving us good opportunities, but by no means at a very elevated level. And the defensive names that we are allocating to still give us good opportunities. But were we to see a market sell-off, were we to see a heightened level of risk aversion and cheaper companies being thrown out as the market panicked, then it's highly likely that that would give us opportunities and we would deploy more capital into those types of situations.
That makes a lot of sense. One thing that stands out about your fund, I think, relative to your typical growth or quality funds, those funds are normally very highly concentrated in 22 or maybe 30 stocks, if that much. You said you hold anything between 80 and 100 stocks. Is there any particular reason for that? Or was it more optimal from a risk management perspective? Or how did you get to that number?
Well, certainly risk is a key component part of it. I mean, 80 to 100, we still feel allows us to be highly active. It is still allowing us to focus on the more attractive opportunities. We are looking at a very broad global value opportunity set. But at the same time, it does enable us to carefully control individual position sizes. And as I mentioned, some of the most exciting opportunities are those deep value names that potentially could double or triple. But at the same time, they clearly have an element of risk that may mean if we were to be wrong, they could have meaningful downside. So by having 80 to 100 names, that does enable us to allocate maybe a position in the portfolio with only perhaps a 50 or 60 basis point position, but it can still be meaningful in terms of its performance contribution. Were we to hold only 20 or 30 stocks in the portfolio, it would be very hard then to individually control for that type of situation. Either we would need to make it a bigger position, which would be introducing a higher degree of risk in that one individual name than we would feel comfortable with, or alternatively, if it was only a 50 basis point position when the average of all other names was over 3%, it would have really a secondary status within the portfolio. So 80 to 100 enables us to be truly active, but also enables us at the same time to carefully control risk and to take an appropriate degree of exposure to those more exciting, higher risk situations.
The next also partly speaks to a question from our audience with regards to turnover in the fund. I mean, holding 80 to 100 stocks, just to get a sense or feel how actively you can change positions. On average, what is the turnover of your fund?
We typically expect turnover to be between 60 and 100%, and we make no apologies for that figure, and it is higher than many other value funds will demonstrate, but we feel it is absolutely appropriate. Firstly, this is truly actively managed. We need to make sure that we are capturing the best 80 to 100 ideas at any specific time, and that figure is particularly biased upwards by our management of our higher risk, deeper value situations. As I think one of the audience has noted, we do indicate a shorter degree of timeline for our deeper value opportunities. And that is because we have noted over really running this fund for over a decade, it is typically better to be impatient with these names. When a low quality, deep value name starts to disappoint and to go off track and our investment thesis has less conviction, we typically find it is better to sell early and to move on to many of the other exciting opportunities that we have, because as I mentioned, value investing is littered with value traps. And this will be a persistent theme and one that we need to be careful about. And we find that once a stock starts to perform worse than we expected, then it can often be better to move on. So the average holding period for our deeper value, higher risk names is very often closer to 1 year. But our more defensive, higher quality names, they can be in the portfolio for quite an extended period of time. And indeed, when the controversy or the problem is resolved and the share price recovers in a defensive name, they can still remain in the portfolio because they generate good levels of free cash flow typically. They can compound value. And if we have been presented with the opportunity to buy a good business at a very attractive price, then we feel we need to be more measured about when we exit that position. Valuation must always be attractive, and as soon as valuation becomes unreasonable, we will exit. But until that time occurs, then again, another learning from the last decade and beyond is that we can be patient with those higher quality names in the portfolio.
I think that answered my next question as well, with the exposure to deep value, because normally when I see deep value, I get the heebie-jeebies. But like I said, you actively manage those positions to make sure you don't get stuck in a value trap. Another question from the audience. You showed some exposure in Japan. What is your views on value in Japan at the moment?
Well, Japan has many, many exciting opportunities, and we do believe we have seen quite a dramatic change in corporate governance and the opportunity set in Japan over the last 10 years or so. So in particular, we have good representation within IT companies, but also industrials and healthcare, communication services. 15, 20 years ago, there was a real risk, but when we could theoretically observe value in a Japanese situation, it may not have been realized. But now companies themselves have been truly much more active in terms of capital allocation, in terms of capital distribution, and indeed direct activism is now becoming more marked in that country as well. So Japan certainly has good opportunities. We are overweight that country, but at the same time, there are many attractive opportunities in other parts of the world. So the overweight may not be particularly pronounced, but it is an illustration of the good opportunities that we can see.
Andrew, we're running short of time, but if we can we take another 3 questions or so? Are you still okay with time?
Absolutely, please.
Yeah. Let's talk a little bit more about China. I mean, a lot of talk around China that's counter-cyclical to a lot of developed markets. But it seems as if the unlocking of China is going to be more beneficial, from a inward perspective, not necessarily for the rest of the world over the next year or 2 years. Just your views on China. Your EM exposure, you said, can be anything between 0 to 10. Do you take specific positions in China at the moment?
Yes, we have currently 4 investments in China, and China has been a persistent allocation. Currently, it is just over 2% of the fund. So, a component of that 7% total overweight to emerging markets. And the Chinese market has clearly recovered quite sharply in the last 6 to 9 months. It really was deeply out of favor with many investors, but the reopening of the economy, along with some realization that worst fears about regulatory and political interference are not being realized, has led to some recovery. But we still can find strong value opportunities in that marketplace. And certainly 6 to 9 months ago, there were situations that were trading below cash on our estimations. So we have exposure to communication services. We have exposure to a Chinese shipbuilder that has been a very interesting restructuring story, and also some exposure to the Chinese automotive market as well. So 4 individual holdings, collectively just over 2% of the fund. So we're tightly managing our risk exposure, and this should be seen alongside the existing positions in other emerging markets companies such as Vietnam, Brazil, and India. But China, yes, is certainly a very valid hunting ground for us, not least because we have on the ground research analysts, as well as dedicated regional strategies, and they are a great assistance to us in identifying value opportunities that rank well on a global perspective.
Just as a matter of interest in that EM screening, do you look at countries like South Africa?
Yes, certainly. And in the past, we have invested in South Africa, but we have had no direct exposure for the last couple of years.
Right. Let's just talk about financials. You showed overweight position in financials. We've seen the latest news on First Republic. We've had the issues around SVB. Just your views on the financial system or the banking system as a whole. And if you overweight financials, what is that specifically? Is it banks or other financial sectors?
Absolutely. So, well, let me take the latter question first, Eugene. So we are slightly overweight banks, but the more significant overweight is insurance. And insurance to us is a very attractive industry. Its pricing is improving. Capacity is being withdrawn, and this is especially true in reinsurance. So we feel the opportunities are very significant in this industry group, and the sell-off in insurance as a result of the banking crisis has clearly hindered shorter-term performance, but actually has given us more opportunities, and they are certainly positions that in the main we are defending. In terms of banks specifically, we had no regional bank exposure in the US, and that continues to be the case. But clearly the banking sector as a whole has sold off, and collectively that is starting to give us some interesting areas to investigate further. One name that we added to the portfolio in March after the sell-off was Charles Schwab, the US broker, which did perform quite poorly because the market was concerned about the risk of deposit outflows. But we felt that the risk was being very disproportionately priced. So we introduced that name at a modest position into the portfolio. Undoubtedly, though, across many smaller regional banks, risks do remain. we have seen the sharpest tightening cycle in history. Credit availability is lessening, so one has to be still very circumspect about where one invests across the US banks. But certainly amongst the larger banks, we continue to have good exposure to names like your JP Morgan, Wells Fargo, and Citigroup, where they continue, if anything, almost to be beneficiaries of the distress that is occurring in the US regionals, as well as the flows in deposits that we are seeing across the industry.
Interesting times indeed. Let's just talk about, always from a South African ZAR perspective, we're always curious about currencies. You did mention in your presentation that you can, from time to time, deploy currency hedges. What's your takes on the dollar at the moment? Obviously overvalued, especially even relative to the pound and the euro. Do you think that the dollar is probably going to continue to hold up for longer than what we hope for?
I think with currency hedging, we're extremely careful about not taking an implicit bet on currencies. And although we do have views on the dollar that I would say are generally bearish, I think the investment landscape is littered with equity investors who try to profess a view on currencies. So, but yes, we would not be surprised to see a dollar weakening from here, certainly when we look at traditional valuation metrics, certainly relative to other currencies. The dollar does seem to be towards the top of its realistic range. And it remains to be seen what the next 6 to 12 months develops. But essentially, we are not looking really to overlay a view on currencies alongside our individual investments, because we want our stock-specific insights to be driving the performance of the fund.
Perhaps very last question from the audience. We covered the Global Equity Value Fund today. You've shown a whole range of products being managed by T. Rowe Price over a couple of decades. Which fund in particular is of more interest right now? I would think the Value Fund, but from your stance?
Well, I think really it depends upon where investors are looking to allocate. I think it's certainly true that many investors are underweight value. Or perhaps even overweight growth, and that may have started off not as an intentional allocation, but given the nature of performance, that is where they've ended up. So I certainly feel there are extremely strong arguments for a good value allocation within investors' portfolios in view of the inflation and interest rate environment that we face in the medium to longer term. But at the same time, we have some excellent growth strategies at a global level, as well as a global select strategy that is more core in nature. So we basically look to utilize and leverage the strong insights from our fundamental research platform across different styles and different regions. Clearly, I have a close interest in the Global Value Fund, and I would certainly strongly support its credentials. But we recognize that many investors require a more balanced style exposure as well.
Good answer that. And I mean, from our side, again, great to have you on board with the launch of the BCI T. Rowe Price Global Equity Value Feeder Fund. To our audience members out there, it's available on the Momentum Wealth and Glacier platform already. If you want it on any other platforms, please get hold of us. We'll make sure to get it listed wherever you want to access the fund. And a quick reminder to our audience, next week, the Global Conference, hoping to see lots of you there live in person. You'll see a little bit more of T. Rowe Price there as well. Andrew, I do believe you are going to do a recording for that session right after this. So we are keeping you very busy. And thank you so much for your time this morning. It's been extremely insightful and exciting at the same time. So thank you so much, and to our audience out there, thank you for joining us. And we look forward to a lot more engagements with you in the near future. Thank you, Andrew.
Thank you all.